Well, the results season is going to well and properly hit from tomorrow when TCS announced its numbers, though today we have GM Breweries. So it's a very good time to look at the results season ahead. And we have perhaps someone who's best in the business, Gautam Dugar, the head of research institutional equities at Motilal Oswal Financial Securities. Gautam, thank you very much indeed for joining us. We have tried to put out as many takeaways from your huge, 130-page report, earnings preview. Well, one of the first things that intrigued me is that it's a damn good earnings growth. Nifty companies, 21%, MOFSL universe, 40%. But it looks like much of it is only because of the OMCs. If you remove the OMCs, it's a okay kind of earnings season. Is that right?
Lala, good morning. Thanks for having me. I won't call 20% growth is okay, because even if you look at my coverage without OMC, we're still talking about a 20% growth, right? So last quarter, we had 52% growth for our coverage. Without OMC, it was closer to 30%. Even last quarter, Nifty was 32%. Without OMC, it was 18%. And this quarter, as you rightly pointed out, we are penciling in a 21% earnings growth on Nifty. And without OMC, I think it is somewhere close to 15%. So very strong performance, Lata. It's coming on a very high base. If you look at Nifty's earnings over the last 3 years, they've compounded at 23% from FY20 to 23. So on that base, not only are we talking about a 20% growth for this particular quarter, we're also saying for a full year growth also, it is somewhere about 22%. So it will be very strong corporate earnings for FY24. Whichever way you slice and dice it, you look at X financials, X commodities, or X OMCs, numbers are looking very strong overall.
I just went by this X OMCs. You see 15%. It kind of took away the shine from the earlier big numbers that you threw at us. But you know what was most shining about your entire report? The earnings growth for MOFSL's mid-cap universe and small-cap universe. That's 104% increase. I mean, that's big. So do you think that we have to look for some very sparkling performance in mid and small caps now?
So, Lana, I will take that with a bit of a pinch of salt always, because there are a lot of base-related effects. There are a lot of commodities which are part of mid-caps and small-caps. They're not part of Nifty companies. So you have to look at mid-cap, small-cap earnings always as a trailing 12 months average rather than get, worried about 1 or 2 quarters of a very strong performance, because there are many base effects which are at play right now. For example, if you look at cement sector has had a very horrible run for 7 quarters in a row. The last time cement sector in our coverage universe reported earnings growth was in September 2021. After that, there have been 7 consecutive quarters of earnings decline. And this quarter, we are seeing a 72% earnings growth on that extremely low base. Right? Similarly, OMCs, we are talking about some earnings doubling, tripling there on a YY basis. But markets will look beyond that, right? Because things can change very rapidly in those very volatile and cyclical segments. But yes, if you just look at the categorization for this particular quarter, you're seeing a very high base, high growth in both mid-cap and small caps.
Okay. All right. Let me come to the overall picture itself. It looks like this is going to be more a margin and EBITDA-driven quarter. Sales is not what you're looking at.
So, Lada, look at it in this way. Overall sales growth is somewhere close to 6 to 9% in different set of aggregates. But when you look at sales growth X of commodities, it is about 13%, which essentially tells you that X of commodities, the sales growth is still very robust. Why is it depressed at 6%, including commodities? It's because of a very high base for commodities in the base quarter of September 2022. So that is why if you look at aggregate sales for Nifty and our coverage, it will give you a very different sort of a picture than what actual the underlying reality is. Yes, there is a broad-based margin expansion across the sectors. Auto, once again, the 4th consecutive quarter, where it will turn out to be the best performer in a variety of sectors that we cover. You are seeing good margin expansion as we discussed in cement. Same is the case for consumer. You're seeing margin expansion in metals, oil and gas. The only sectors where margins are expected to remain very flattish is healthcare and IT. at an aggregate basis, we are talking about a 350 basis point of a margin expansion for both our coverage as well as Nifty, excluding financials, right? So yes, this is a quarter where the margin expansion is very broad-based, which is why when you talk about a sales growth of 6-7% and EBITDA growth of somewhere about 18 to 20%, that is what is clearly evident, that the operating profit growth is clearly led by margin expansion, because volumes in many sectors like consumer are still very, very tepid. In some other sectors like cement and auto, they are healthy, but in consumer staples, you're still seeing volume trending very low.
Oh, okay, so that would be a point of bother. Yeah, as you pointed out, autos 87% YOY rise in earnings, and cement are likely to be the standout sectors. Do you think we can be surprised even on the upside? Is there any sector that's going to really dazzle?
So
better than your expectation?
I think possibly auto can surprise again, because see, auto, there is a bit of a history. For FY18 to FY23, the earnings went nowhere. You know, the auto profits of FY18 in Nifty companies was 28,000 crores, and it was 28,000 crores again in FY23. Between FY23 and FY25, we are talking about profits doubling for auto sector from 28,000 crores to 57,000 crores. It went through 16 consecutive quarters of downgrades. And now last 3 quarters, we have seen consecutive upgrades. The December quarter, which is basically the January result season, April and July. And even in this preview, we marginally moved the numbers upwards for auto sector. So it is having a very good time right now, both from a volume as well as a margin perspective. And given the element of operating leverage which kicks in, you tend to get surprised on the upside. And when things were bad for them for 4 years, you were getting surprised on the downside. So auto is something which I will say one sector. Second is PSU banks. I mean, we have seen banking sector. When I said auto went through 5 years of a horrendous time, this is exactly the when banking profits went to 5 times in 5 years. And even that expanded base of 212,000 crores of profit which they delivered in FY23 for Nifty 11 BFSI companies, we're talking about a 27% growth in financial earnings, though it's not linear. Every quarter you will see moderation in banking growth now, right? So 1Q was the best, 2Q was slightly lesser, and 3Q and 4Q, the growth will moderate even further. But on aggregate for the full year FY24, you're still talking about 25-27% growth in financials, which is very strong.
Oh, yes, no taking away from that. But yeah, important that we've already seen the best quarters for banking and finance. Margins are likely to be under pressure in the results that will come in the second quarter. Now, let's discuss about prices, Gautam. You know, your Nifty EPS for the current year is almost 1,000 rupees, 986, which means we are 20 times. I mean, at the moment, it's very easy to divide. 20,000 Nifty, 1,000 rupees EPS. So we are at 20 times. Is that an attractive place to buy at all? You know, there are people who argue that in good times, we have traded for a goodish bit at 22 and 23. And so, you know, there is still reason to hold on.
So I think when you look at numbers now, you have to move forward on 12-month basis, right? When you talk about 986 is the EPS for March 24, which is just 6 months away, right? In another 3 months, markets will move on FY25, right? So where we are at around 1,130 rupees. So let's say one quarter down the line or 6 months down the line, if you're discounting FY25, I'm just giving you maths. I'm not making any predictions. Let's assume that this 1130 rupees of EPS stays intact. There's no downgrade. Or maybe it moves down to 1100. And the current P, which we are talking about, 20 sustains. So if you just do the maths, 20 times 1100 gives you 22,000, which is the calculation for Nifty. Let's say the numbers look very optimistic and something happens globally or domestically, which pulls the market EPS down by 10%. From where we are today, 1130 to say 1050. If you're talking about 20 times on that number, you're still talking about 21,000. So if this earnings growth is very critical, if you look at last 3 years when Nifty compounded at 23%, Nifty gave you 27% compounding between the similar period. And I'm not just singling out Nifty. You look at NSE 500, which almost represents 90% of the India's market cap. NSE 500 is an index earnings compounded at 28% for those 3 years. And the index gave you 31% compounding. So ultimately, end of the day, what matters over a
Is
period of
earnings.
time is corporate earnings. Everything else, macro rates, news flow, geopolitics, it falls by the wayside over a period of time, right? So corporate earnings, if they stay intact and this 986 and 1130 is delivered, you still have a decent, goodish bit of upside. As far as valuations are concerned, if you look at a 10-year average of Nifty PE, we are at about 20 times. If you want to take a very bearish picture and say, I want to look at 20 years of PE, then 20-year average is somewhere close to 17 and a half, 18 times. So if you compare versus 20-year average, we are 10% expensive. If you're comparing versus 10-year long period average, we are bang in line with the long period average on Nifty. The problem is in mid cap and small cap indices, which are very expensive. And especially mid cap index is trading at about 15 to 17% premium to Nifty and its own long period average.
Can you leave us with one or two stocks where you see huge valuation gaps?
Sorry, can you come again? I missed.
Valuation gaps where, you think the market has not yet caught on to a good stock. Can you leave us with some stock ideas?
So my stock ideas are there all over in the model portfolio. But if you are talking about sector, I would think banking is looking very attractive from a valuation point of view. A sector has delivered excellent earnings, but the underlying market cap has not kept pace with it for a variety of reasons. Maybe the sector is overowned. Maybe people are concerned about the margins. Maybe people are concerned that the best of the cycle is already behind. But if you see my allocation in the model portfolio, our single largest overweight is still PSU banks and NBFCs. Then we have a significant overweight stance on consumer discretionary. Out of the 8 consumer stocks that we hold in the model portfolio, 7 are consumer discretionary, where conviction is very high on Titan, Indian Hotels, Zomato, and DMart. Right? And then we have been continuing with our large overweight stance on automobiles, where we have positions in Mahindra and Mahindra, Ashok Leyland, Bharat Forge, and Craftsman Automation. And this revision, we marginally increased the weight on pharma, made it overweight from neutral, where we added Cipla and Medanta. And yes, last but not the least, definitely industrials, which has done phenomenally well over the last 2 years. There, the big overweight continues with L&T, and incrementally, we've added Bharat Electronics. So that's the published model portfolio.
Okay, that's a great summary of all the stocks that you have recommended. Thank you very much, Gautam, for joining us. We will look forward to how the results season pans out starting tomorrow. TCS. Wrap up on Bazaar on that note. Chartbusters up next.